Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Riiv to receive the top 10 stocks to buy right now. Spotify reported fourth quarter earnings before the market opened on Tuesday, and it was a pretty mixed report depending on how you're looking at this stock. The company reported negative free cash flow, which is never a good sign, especially after it's generated free cash flow for a couple of years in a row now. But there were some positive signs in the company executing its long-term strategy. I want to get into the reason behind its recent losses, what it's doing to fix that, and what I think about this stock long-term. My name is Travis Hoium. Thank you for watching Riiv Investing. If you're not subscribed already, please subscribe here on YouTube and share this video with anybody you think would be interested. Let's dig into the numbers here. At a high level, the first thing that Spotify reports is their monthly active user numbers. Pretty solid growth across the board. You can see 20% year over year and 7% quarter over quarter. What I'm really interested in here is the ad-supported tier. That's where I would like to see growth because those ads can not only be used on the music side of the business, but also on podcasts. 25% growth in the number of users for that ad-supported tier, 8% growth quarter over quarter. Those are really great numbers. On the financial side, 17% growth quarter over quarter. I think that's really impressive, especially given the economic backdrop. We're seeing a lot of companies pull back on advertising spending. So if they're spending more money on Spotify, I think that really shows the company's executing well on its advertising strategy. It will take a really long time for this to become a really big piece of the business, even match that premium side of the business, but definitely good progress in the meantime. You can see this free cash flow number here. A year ago, $103 million of free cash flow, and last quarter, $73 million. I'll get into a few reasons for that in just a second, but it is pretty understandable when you know the background. The financial summary adds in gross margin and gross profit. You can see that gross margin has dropped a little bit, 26.5% a year ago, 25.3% in this quarter. The operating margin was about break even a year ago and now negative 7.3%. That's the reason that we had that negative cash flow number. But there is $3.4 billion of cash and investments on the balance sheet. So this is still a very strong financial company. On the gross margin front, you can see that premium gross margins to be pretty strong, 28.6%. We'd like to see that over 30%. Management said that they think that the blended gross margin or gross margin across the business can be over 30% long term. But we're a ways from that, both on the premium side and the ad-supported side, 5.1% for ads. We have seen that number go negative periodically on a quarter-to-quarter basis. And what Spotify does is include all of its podcast costs in that ad-supported segment. So when they write a big check to Joe Rogan or Dax Shepard, that money comes out of this ad-supported gross margin figure. So that's why that's a little bit lower than premium gross margin, just to give a little bit of background there. The operating expenses is really where we see this loss come in and the negative free cash flow come in. You can see here that across the world, operating expenses are growing more quickly than revenue. Research and development is really the big one here. And the purple segment on both of these is what is reported in their figures. Spotify is a European company. So the strong dollar, all of the people that they're paying here actually makes that look more expensive in euros, which is what they're reporting. That's why this purple number is higher than the green number, which is on a constant currency basis. There are a couple of items to talk about here. One is the company's rate of expansion. At the end of 2021, Spotify had 7,690 full-time employees. At the end of 2022, that had jumped to 10,151. So more than a 25% increase in the number of employees. So they did announce that 6% reduction in headcount in January, but that's nowhere near the number that they added throughout 2022. So management did reiterate that this was a year of investment, last year was, and that will pay off over time. But we do need to see them contain these costs, these operating costs, throughout 2023 and 2024 and going forward so that they get the operating leverage as they grow the top line. Outlook for the first quarter is a lot of the same. Total monthly active users of 500 million. That would be up from 489 million at the end of the fourth quarter. Premium users, 207 million, up from 205 million. But there will be margin pressure. Margin expected to be 24.9% from 25.3% in the fourth quarter. And again, an operating loss. This does include 35 to 45 million euros of impact from that headcount reduction that I talked about earlier. So keep that in mind. Management said in the conference call they expect margins and profitability, free cash flow, all to increase throughout the year. They didn't give a lot of numbers on that, and they're not giving full year guidance, but look for that throughout the year. I think the first quarter is probably going to be a low point from a free cash flow and operating income standpoint. But if Spotify can continue growing specifically on that ad-supported side of the business, there should be a lot of operating leverage to be had. We could see the company get back to free cash flow positive and hopefully net income positive, potentially sometime in 2024. What I'm really looking at with Spotify is, are they executing on their long-term vision? And I think the answer to that is yes. The user growth numbers are really good. That's going to be something they're going to be able to leverage in multiple ways. And what I want to see is them building that advertising business. That's where they're going to be able to actually have some pricing power and generate better margins than they do in the music business, where they have to share that revenue and profitability with the music labels. So there's going to be a cap on the profits that they're going to generate from that premium segment. But on the ad side of the business, if they can build a good ad-supported business, they're going to be able to attract more talent, more podcasters, and attract more listeners. They sit in the middle and provide that advertising service a lot like a Google does, like a Facebook does. That's a very profitable segment to be. They have a long ways to go in growing out that business, but that is the segment that makes me most bullish on Spotify long term. This is a stock I own, and I really like the quarter because of the strategic momentum. But we do need to see throughout 2023 management control those operating costs so that we see operating leverage start to hit the bottom line. What do you think about Spotify's quarter? Do you like the direction the company is going? I'd love to hear your comments in the comments section below. Give this video a like, and of course, follow Riiv Investing. I really appreciate it. Thank you for watching, and I'll see you here next time.